Australia's job market just imploded. The latest numbers show unemployment rocketing to a 1.5-year high. April's data was a bloodbath, driven by a female job slump that nobody saw coming. Australian dollar to US dollar sold off hard, slicing through short-term moving averages like butter. But right now, as price hovers just above 0.7109, there is a setup that could trap every trader who panicked. While the herd chases the breakdown, global risk appetite is still charging. Iron ore is holding, Chinese data is resilient, and the S&P 500 is knocking on all-time highs. This is not a straightforward collapse. This is a dangerous pivot point where fortunes are made and lost in hours. There is one danger zone and one hidden opportunity today. I'll show you both. Stay until the end. I'm giving out 3 exact entry and exit levels you can use right now. Here is your instant market verdict. The session bias is a fading sell within a larger range, with a sharp bullish undercurrent from the weekly and monthly charts. We are range-bound on the day with a bearish tint, but that tint is deceptive. The one invalidation level that proves this bias wrong is 0.7070. Write this number down. If we break 0.7070 today, the whole structure shifts from a healthy correction to a much deeper bearish wave. Until then, this is a buy-the-dip opportunity inside a strong uptrend. Let me walk you through exactly what I see. Start with the Godfather timeframes. Monthly chart. Strong buy. Price is above every major moving average, and has been carving higher lows since last October. Weekly chart. Strong buy. The 100-week moving average at 0.7015 is rising. The 200-week at 0.6855 is sloping up like a launch pad. This week we've pulled back from the 0.7200 resistance cluster, a normal retracement after a multi-week rally. Nothing broken. Now step down into the daily chaos. The daily trend flipped to sell. Prices closed below the 5-day moving average at 0.7150, below the 10-day at 0.7164, and below the 20-day at 0.7162. These 3 averages are now bunched together like a lid, right between 0.7150 and 0.7165. That's your immediate resistance zone. The daily MACD line is reading 0.001, dead flat on the 0 line. This is a momentum stall, not a bearish conviction signal yet. If it turns negative, we get confirmation. RSI at 46 is not oversold, so there is room to fall further, but it's also not breaking down with velocity. Now the intraday battlefield. 5-hour trend, strong sell. 1-hour trend, strong sell. The 4-hour chart shows a string of lower highs, with the 20-period moving average crossing below the 50-period, a classic bearish alignment. But here is what most traders miss. Price is now sitting directly on the 50-day moving average, which comes in at 0.7115. That's the first line of defense. Just below it, the 0.7109 level is the clear swing low support from last week. This cluster at 0.7109 to 0.7115 is the brick wall. The 200-day moving average is way down at 0.6855, not in play. So the technical picture is a bearish short-term momentum smashing into a structural bull trend support. These collisions produce violent reversals or decisive breakdowns. There is no middle ground. Here's the next signal that changes everything. On the 60-minute chart, MACD is deeply negative but starting to curl up, hinting at a potential bullish divergence if price can hold support. RSI on the 60-minute is near 34, approaching oversold territory. The price is coiling. The trigger is simple. A 1-hour close above 0.7125 would be the first sign that buyers have absorbed the selling and are ready to push back towards the MA cluster at 0.7150. Conversely, a clean 4-hour close below 0.7109 opens the trapdoor to 0.7070, the next major support and the invalidation level for the entire bullish structure. Now let's connect this to the fundamental driver and the cross-asset narrative that is invisibly shaping this market. The headline screams Australia's unemployment rate spiked to a 1.5-year high in April, with a sharp drop in female employment. That is a domestically bearish shock. It gives the Reserve Bank of Australia a headache and reduces the odds of any hawkish surprise in the near term. Under normal circumstances, Australian dollar to US dollar should be falling off a cliff. But circumstances are not normal. Right now, we are in a regime of relentless risk appetite. Look at the S&P 500, look at Bitcoin, look at high beta currencies. The market is willing to overlook bad local data if the global tide is lifting all boats. And that's exactly the narrative in the analysis piece you're seeing. Weak Australian data meets relentless risk appetite. The China proxy role of the Australian dollar is alive and kicking. Iron ore futures are stable. Chinese PMI data earlier this week showed expansion. The Asian demand story has not crumbled. So we have this tug-of-war, a domestic anchor pulling down, a global risk current pulling up. In these conditions, price becomes a magnet for traps. Traders who sell the news get squeezed when the bigger trend reasserts. Traders who buy too early get shaken out by the intraday momentum. This is a professional's environment. Add another layer. Gold is trading firm, bolstered by geopolitical anxiety and real yield dynamics. That feeds into a positive commodity currency backdrop for the Australian dollar. Typically, a strong gold bid supports AUD oil is also not collapsing. So the commodity complex is providing a gentle tailwind. The crosscheck with the US dollar index shows the DXY struggling to hold its own bounce. If the dollar weakens again, the Australian dollar to US dollar will explode higher from this support. That is the hidden opportunity. My1 to 2-week directional lean is cautiously bullish above 0.7070. I expect this support zone to be defended, and I am looking for a bounce that retests the 0.7200 handle. The exact event that would invalidate this thesis is a daily close below 0.7070. If that happens, the correction has gone too far, and the weekly trend comes under threat. We would then target the 100-day moving average at 0.7015 and possibly the 200-day at 0.6855. But as long as 0.7070 holds, I am buying dips, not selling rallies. Most people will skip this next part, but this is where money is made. Keep watching. I'm going to give you 3 precise trade setups with exact levels, stops, and risk-reward logic. Strategy 1. The sniper, conservative. This is for traders who want high probability and are willing to wait for confirmation. We buy into the support zone with a limit order. Place a limit buy at 0.7115, right at the 50-day moving average and just above the 0.7109 floor. Your stop loss goes at 0.7102, below the intraday swing low and the hard support. That's a 13 pip risk. Target 1 is 0.7150, which lines up with the 5-day moving average and the first intraday resistance. That gives you 35 pips of reward, a risk-reward ratio of 2.7 to 1. Target 2 is 0.7178, the upper resistance and a test of the broken MA cluster. That's 63 pips, a risk-reward of 4.8. What voids this setup? A 1-hour close below 0.7109 without any bullish reaction. If we break and hold below that level, cancel the limit order and stand aside. You do not try to catch a falling knife. Strategy 2. The active trader, standard. This uses a momentum confirmation entry to join the bounce after it has already started. Wait for the price to break above 0.7130 on the 15-minute chart and then hold a retest of that level as support. Enter long at 0.7130 with a stop loss at 0.7108, just beneath the daily support and the previous consolidation low. Your risk is 22 pips. Target 1 is 0.7155, capturing the move into the short-term moving average resistance for 25 pips. Roughly a 1-to-1 risk-reward initially, but you will use a trailing stop. Once target 1 is hit, move your stop to break even. Then let the trade run to target 2 at 0.7180. That second leg delivers a total of 50 pips from entry, pushing the effective risk-reward beyond 2-to-1. The trailing stop rule after break-even. Use a 15-minute swing low or a 20-pip trailing stop from the high, whichever is tighter. This setup works because it confirms that buyers have wrestled control from the intraday sellers. Let's see how aligned we are. Type your Australian dollar to US dollar range for tomorrow in the comments now. I'm reading them. Strategy 3. The Aggressor. High risk. This is for those who believe the breakdown has legs and want to short into weakness. It is a counter-trend trade against the weekly bull, so it demands tight discipline. Enter a sell stop at 0.7108, 1 pip below the key support, anticipating a flush. Your stop loss goes at 0.7125, above the breakdown point and the recent minor swing high, risking 17 pips. Target 1 is 0.7070, the next major support and the invalidation level for bulls, giving 38 pips and a risk reward of 2.2. Target 2 is 0.7030, a level where the 100-day moving average starts to come into play, offering 78 pips. This is a momentum chase on a smaller timeframe extreme. Only take this trade if you accept that it fights the larger trend and that reversals can be violent. If price spikes back above 0.7125, get out immediately. No hoping. The warning stands. This is only for those who know how to lose small and manage risk aggressively. Now the risk management pulse. Never risk more than 1 to 2% of your account per trade. No positions through high-impact news events, especially Australian employment data or US inflation releases. Stops are non-negotiable. Set them and walk away. Here is your close and retention loop. The single most critical level for the next session is 0.7109. If that level holds, the bulls are back in control and this entire sell-off becomes a beautiful buying opportunity. If 0.7109 breaks and we sustain below it, the floor opens to 0.7070, and the structure enters a much choppier, dangerous phase. Tomorrow's focus will be on any fresh RBA commentary and the China trade balance data that will directly test the risk appetite thesis we just mapped. If you want the full breakdown on the US dollar index and the S&P 500 divergence, that video is live now and waiting for you on the end screen. Smash the like button if this analysis gave you a clear, executable plan for today's session. Subscribe and hit the bell for daily institutional grade coverage across all 8 major assets. I'll see you in the next one.